Good morning, everyone. Let's start the webinar, by the way. So thank you, everyone. Thanks for joining this webinar, your playbook to 10 crores, by the way. So first, okay, right now I'll just go through the gaps, what we found. So we reviewed over 50 kind of HNI portfolios this year, by the way. And we expected these gaps are not mostly in returns, by the way, but mostly on poor kind of selection, I would say, or kind of even timing mistakes that kind of mostly people kind of not given much concern. So the biggest gap consistently across the portfolio is kind of most of the thing is structure, by the way. So not what people are investing in or but how everything was put together. So many portfolios look good on the surface with a good strong fund, good stocks, even a decent past performance. But when we look deeper, there were no clear role for each investment, I would say. So some were overexposed to equity without realizing the risk, by the way. So others were sitting too heavily in the fixed income and missing the growth. So many were simply a collection of ideas added over time without any kind of good coherent synergy or strategy, I would say. And this is where most investors unknowingly get stuck. Because see, they focus on choosing the right product instead of building a right portfolio. The truth is, wealth is not created by one great investment. It's very important. It's not created by selecting on great investment. It's created by how different investment work together. And this gap between having investment and having a structured portfolio is exactly what separates someone who reaches 1 crore from someone who reaches 10 crore. So yes, today what I want to do is help you to see the difference clearly and more importantly, show you how to fix this stuff. So now let's talk about the real problem what we see. So especially in the bracket of 50 to 1 CR segment, because this is where most investors are today and also where most mistaken mistakes are kind of taken more kind of more built up, I would say. So what we observed is that portfolios in this range usually fall into some kind of three broad pattern. The first is what I call is all equity convention, kind of having more concentration towards any particular sector or so. Even the kind of mutual fund stock, even the PMS also, because market have done well in the past, and there's a belief that equity is the only way to grow. I also totally agree. It is a kind of a good kind of a tool to grow. But the problem is equity itself back kind of lack a good balance, I would say. So when the market correct, these portfolios take a hit that investors are not mentally prepared for that. And that's when the panic decision happened, by the way. You can just go through the month of March, particular month's performance. You can see the hit was really very bad than a whole year hit what you're seeing. So the second thing is the opposite. That is kind of people are right now thinks that equity is not much safe. So they move towards more safety first portfolios where their large portion is kind of sitting in a fixed deposit. Still in this era, they're in fixed deposits, debt funds, and a low yield kind of instruments. So these investors are trying to avoid risk. But see, doing so, they are also limiting their ability to grow. So over time, this inflation quietly eats their wealth and they don't even realize the opportunity cost what they're missing. And also, you see, the third thing is the probably the most common, that is what I call the random portfolio. So this is the things that where the built over kind of a time based on suggestions from someone recommending a fund, a friend suggested a stock, a relationship manager pitched a product, or someone looking to kind of looked on some good social media post or some social media follow. You may follow some good social media person. So the portfolio becomes kind of a collection of ideas, not a strategy. And when you ask a simple question, why is the investment here? This is kind of you don't have good clear answer to answer, right? So there is no kind of a defined role or no clarity on how it contributes to the overall goal and no understanding on how all these pieces fit together. And this is the kind of a core issue what I found in most of the portfolios. So most investors are making decision in isolation, not in the context of the portfolio, what they should do. They are choosing products, not designing the outcomes. See, that's why kind of you have to make the question in the right manner. So the right question is not like what should I invest in, but how should my portfolio be structured Because once the structure is right, product selection becomes much easier. This thing is the thing where most of the kind of person who are in the market also missing a lot, I would say. Because see, without a structure, even a good investment can lead to a poor outcomes. So see, before we move forward. You see, I want you to reflect on your own portfolio. Are you all in one set, or are you building something kind of something that actually works together? Just think about it. Okay, so fine, we can discuss this moving forward. So see, now this is where the real shift needs to happen, I would say. Because most investors actually don't realize that the problem is not lack of opportunity. It's about how they approach investing itself. Most people are constantly chasing the products. If a fund have done well in the last 2 or 1 year, they want to enter in, by the way. That's what we saw in the silver rally kind of in the recent time. So if a sector has given a strong return, suddenly everyone wants to exposure in that, by the way. And on the flip side, you want to see that also when something falls, the assumption is that it has become a kind of a good buying opportunity also, without really understanding why it has fallen, by the way. For example, we have recently seen with the sector like IT, you can take. So people assume that because the prices have corrected, it must be a good entry point, by the way. But the real question is, have the fundamental improved or deteriorated? People are not thinking about the fundamental or the structural change, what the IT is going on right now. Or the earning visibility is good. Is the global demand is in the same level, or the margin support is making the decision making power even much valuable right now? Most investors don't go that deep, by the way. That's a problem. So they react to the price, not to the business reality. So similarly, the market are doing well. That's kind of a tendency to keep adding to what already worked also. So chasing past winner without asking whether the valuation still justifies the future returns. So this behavior creates the portfolio that are kind of a reactive, not structured. You want to understand the difference. It's kind of more reactive to the things what happening, not kind of a structure what works for you. So yes, over time, this leads to a more inconsistency, kind of a period of good returns followed by sharp drawdowns and more confusion in your head, by the way. So now compare this with how smart investors kind of operate in a separate zone. They don't chase it kind of a products, I would say. They build system. And what does that really mean? If you want to see, like, see, it's like, it means every investment has a role. Equity is for the growth, not for excitement. Debt is for more stability. But see, no, like, that return would be low, by the way, but alternately they are the thing that helps to you give good risk adjusted return, because they diversify the risk, not because they are trending. And also see, all of this you can make in a kind of a good kind of disciplined way, I would say. So the discipline to stick the allocation is a big role. And it's also important to know that the discipline not overreact to the market noise also, and the discipline is to the thing which helps to the rebalance when it's needed. So that's why I've simplified it here. So wealth is not about finding the next big idea. It's simply the structure plus discipline, I would say. Structure ensures that your portfolio is built correctly, and the discipline ensures that you stay on the track even when the market tests your patience. And honestly, you want to know that most investors fail not because they don't know enough, but they because they don't follow proper system. So see, the shift is very simple. Powerful stop. See, the powerful stop, I would say, is that what should I buy in this? Start asking the question like, see, what should I buy in this? That question makes kind of a more trending that, okay, we should go into that. But before, you can just change your way of asking question. How does this fit in my portfolio? So when you make your thinking change in that way, that makes your investment journey more simple and more study forward. So, see, if this is a kind of thing problem what we are facing right now, what we are seeing, the obvious next question is that what can you do differently to come kind of overcome this? And the first step is to redefine what you need. Kind of, you should redefine your risk, by the way. So you should get out from the old mindset of always tracking your performance. See, because see, when you see the performance, you find that the kind of the last month return will be very much negative. You will be have kind of mental kind of deteriorated that this market is kind of not in a stage where should I go still into the investment zone and so. So this is something where you should redefine your risk, by the way. So the real risk is not kind of reaching your financial goal. It's like running out of money at the wrong time, also, I would say, or being kind of forced to make bad decisions during this correction phase. And that's why the simple kind of picking good investment is not at all enough during this time. You need a proper financial plan behind it, a clear understanding of your goal, your time, kind of your time horizon, your cash flow needs, and your ability to handle the risk. So when you think in a broader framework, that redefining the risk is way good impact for you in the long run, I would say. So one of that is that one of the thing what you'll be getting from this is a good clarity, I would say. So the next step is building a multi-asset architecture, I would say. So this means consciously deciding how much should go into equity for growth, how much into debt for stability or for your emergency fund, and so, and what roles this alternative will play, and how real estate fits your overall picture as part of your portfolio. This is where the asset allocation becomes the most important decision you will make, not which kind of a fund or a stock. See, even but how your money is distributed across different assets, right? So, see, this also determines both your risk and consistency of your returns. So now, challenge is that this is not easy to do. Like on your own, I would say. So market change, your life situation changes, and what worked as 50 lakhs may not work at 2 crores or even at 5 crores. That's why serious investors don't do this casually. They work with a structured approach, often with a professional guidance. So this ensures that kind of the portfolio is aligned to their goal and adjusted over time. That's very important. So you design a good goal, but over the time pass, you need to have a good adjusted over time structure also, because the difference between an average portfolio and a well-structured portfolio is one is not just returns. It's a peace of mind, clarity, and the ability to stay invested through the different phases. So if you take away one thing from this slide, it's kind of not just invest plan. It's just like you don't just allocate randomly, I would say. So I would say design your portfolio in a way that makes the thing more structured, more disciplined, and more kind of a risk management oriented way. So now let me explain this kind of very simple way. So almost like how real portfolios evolve in real life. Imagine investors starting their journey. Early on, most of their focus is on growth. They are working, they're earning, and they want their money to grow faster than inflation. So faster than their salary first, by the way, right? So that's where the equity comes in, and this engine of your portfolio, it drives long-term wealth creation. But over time, as a portfolio grows, something interesting also happens. The same investor starts becoming a little more cautious, not fearful, but kind of more aware, I would say. So they realize that protecting what they have built is just more important than growing it, I would say. And that's where the debt plays its role in the kind of bringing more stability. The thing, it's kind of a thing I'm just saying in a normal situation, not like kind of a situation what we are undergoing right now. So it looks like not exciting for you, but it's kind of gives more confidence for the investor's perspective. Now, as the portfolio becomes a larger and more meaningful, the investor starts thinking differently again. They don't want everything moving in the same direction. They want kind of a balance. So they start adding other alternatives like precious metal like gold, silver, and having REITs for their exposure. So these assets behave differently from the equity, right? And this is where the diversification really comes into the play. And when kind of the final layer where many people misunderstand is the real estate. But for most investors, the real estate is more emotional in India, I would say. For experienced investor, it becomes an anchor, but sometimes that provide a long-term stability and potential income and kind of some sense of ground in the portfolio in as a bunch, I would say. So the key thing to understand here is that none of these assets are good or bad on their own. Their value comes from the role they play. So equity grows your wealth, debt acts like a good proactive stand. Also, if you see the alternatives, they also help in the diversify. But the real problem starts here only. So when the person grows from the stage one, they forget about their equity allocation. They will not track their equity allocation. They become more conscious on protection of their wealth, but they forget that how the equity get allocated. Is it still kind of working as per my risk adjusted return or my risk appetite or my risk score and so there the concentration need to be given in a much more deeper way. So now let's talk about the market reality because a lot of investors feel today is not new, it just feels new, right? So if you look at the current environment, there are three things everyone is talking about: high volatility, global uncertainty, and I believe that stock picking alone will solely help, by the way, right? See, market are moving sharply, reacting quickly to the news. You know, the Trump kind of news, what you're seeing, the market react very quickly. Like you can see it go up, down, and so then naturally this creates more anxiety also to the investors. So start questioning whether they should stay invested or whether they should exit or whether they should shift completely to a safer option. So, but here where I want you to take a step back and look at the bigger picture also. If you see this long-term chart of the market, what you will notice is something very interesting. Volatility has always been a part of market. Every few years, there's been a crisis like wars, scams, financial collapses, pandemic, global uncertainty. Still, political uncertainty also is a big key. And at every point, there was a strong reason to believe that this time is different and that market may not recover. But yet, over time, the market has continued to grow, not in a single straight line, but through a phases of ups and downs. So volatility is not an exception; it's a kind of the rule you can set in your mind, and that changes how we should think as an investor. So now coming to the idea, the stock picking matters. Yes, it does, but not in the way most people think. In volatile market, people try to solve uncertainty by picking the right stock or the right sector. But as we discussed earlier, this often leads to chasing what has already worked or jumping into kind of sector because they have corrected, you think, right? The sector just corrected, it's really good like that. The real issue is not whether you pick the right stock, it's whether your overall portfolio is built to handle this uncertainty. Because even the best stock, if placed in the wrong structure, won't deliver consistent results, by the way. So the takeaway here is very simple, kind of more powerful also. Market will always be uncertain. Volatility always exists, and there will be always a reason to feel more uncomfortable. You want to see, it's like you want to go through the situation, I would say. But the investors who succeed are not the one who predict markets correctly every time. They are the one who build portfolios that can survive and grow through different market phases. And that brings us back to the core idea of today's discussion. Don't try to control the market, build a structure. See, this chart I can say in different manner. See, this is something you're not at all in your control. You can just see it's something that's going to happen. You want to keep in your mind. But what you can do is have a good structure. That's what I can say. So even if you understand market and have a good investment, most investors still struggle with this thing called behavior, right? And these are what we call behavioral traps. The first one is chasing winners. When a fund or a stock or a sector that is already done well, it feels safer to enter because you see in the past return. But by the time most people invest, the lot of upside is already gone. And the second trap is reacting to more uncertainty. Every time the goal is so see, when you see the global news, war, interest rate change, election, and so this is a temptation to change strategy completely, either by exiting or shifting to more aggressive stuff. But reacting to this noise often lead to a poor decision. And the third, which is very common, is wrong allocation timing, moving money at the wrong time. Like for example, increasing equity after the market has already gone up without having a proper insight on how the fundamentals are going through and looking at the broader view and so moving to safety after all has fallen, like what we have seen through this war, most people what they are doing right now. So these decisions feel logical in the moment, what you think, but over time they hurt your returns. And the important thing is to understand is that these mistakes are not kind of because people lack knowledge. These happen because there is no system to guide the decision. That's the main thing. Without a structure, behavior takes over, right? Yeah, see, when you don't know what's happening, your mind will not listen to you. If you have proper structure, you know, okay, I will go through this kind of checklist or so. But when there is no structure, your mind will go on like it keeps on going, right? So it's controlling the behavior is not like a willpower. It's about having a clear allocation and sticking to it. Because in investing, it's not just what you invest in. It's like how you behave around it. Ultimately, your decisions, which provides your outcome in long run. So now we say how we view the portfolios. It's important to understand that we are not just looking at returns. So we are trying to understand where the portfolio is actually prepared or what it lies at. The first thing we focus is the business fundamentals. These are the underlying businesses still strong, like are the earning visibilities and the balance sheet intact more, and more importantly, do they still justify being in the portfolio today, right? And not based on past performance or kind of not much into future potential. We have that in our mind. And the second layer is the market environment also, because portfolios don't exist in isolation. Today, we are like we are in the phase of changing and transformation. Global conditions are shifting continuously. Liquidity cycles are evolving. This is here is like to be more unusual. So even more testing also you should keep in your mind. So the way portfolios were structured in 2025 may not necessarily work in 2026. Yes, and that's where active review becomes very critical during this point in time. For example, in March, when market were uncertain and sentiment was very weak, instead of pulling back, we actually kind of nudge our clients to invest more. And we didn't just deploy capital blindly. We ensured that the fresh money kind of directed towards the areas where we find there's a true value for them. At the same time, we were consciously balancing safety and opportunity, strengthening the portfolio without taking unnecessary risk. And now in April, the time continues to go. We are actively restructuring and strengthening the portfolios to align with what we believe is the next macro phase. See, because in market like this, standing still is also very risk, right? So the third thing we focus on is the risk-adjusted return. And risk is our key component in our long-term journey. Not just about how much you earn, but how much risk you take to earn it. That's very important because consistent wealth creation comes from managing downside as much as capturing the upside. So this is where the message comes kind of more clear to all investors. So the fresh capital plays a very important role. It allows you to kind of correct your allocation, take advantage of the opportunity, helps to make your existing portfolio in a very much good structured and a good risk adjusted way. It also allow you to correct your allocation in the long run, by the way. So in fact, many investors have external portfolios that are not aligned to this current realities, and that liquidity can be better deployed into more structured approach in during this period. So the idea is simple. We stay close, we guide consistently, and we adapt portfolios as conditions change. So because in a year like this, it's not about who invests the most, but who invests smartly and stay disciplined. So this is one of the biggest realization in investing. So your strategy stay the same as you grow kind of wealth. In early stage, the focus is growth. See, you are building your base, taking more exposure to equity and aiming for higher return. As your portfolio wealth increases, the focus shifts to more balance. You start managing risk, diversify across different asset classes, not only depending on kind of single way where the money comes in. Eventually, at higher level kind of as your priority also keeps on changing as protection plays more than growth. So the mistake most investors make is continuing with the growth strategy even when their portfolio has grown significantly. But real wealth is not just created, it's managed, protected, and sustained over the long term. So now let's talk the very practical stuff. So because moving from 1 crore to 10 crore is not just one big decision, it's following a structured playbook over time. So in stage one, which is typically you would have been from 50 lakh to around 1 crore, the focus is purely on growth, but this is where the discipline matters the most. Consistent investing, especially through your monthly SIPs, play a huge role here, I would say. It's not about timing the market, it also plays a good role, but about staying invested across cycles, you should have a mindset to keep on participating in this market. Um, and one simple but powerful habit at this stage is the step up investing. Because this thing, most of investors in this the current time, they are just forgetting it. They find that they started their SIP. Okay, SIP is going on, then why we need to care about that? But see, you know you want returns more than inflation. At the same time, you know your returns are increasing. As you work in any field, you know that your returns, your salary will be getting increased. So you need to step up your investment also, as that's what you need to do during the growth phase. That becomes a good kind of like I would say like it helps you to grow in a much more greater way. And just think like that. So when your salary is increasing, you are still in the same SIP, but at the same time, when you found that if I do more step up in my SIP, you know your growth will be much more faster, and you can take this phase like current scenario where the market is slow by adding a good step up in that. Your return will be having a good upward movements, right? So also the diversification also becomes more critical during this point. You can't just rely on one asset class or one strategy anymore. This is where you start building a proper multi-asset portfolio, equity, kind of your emergency kind of funds, so debt, and having a good alternatives for the balance. And at this stage, asset allocation becomes more important than individual product selection. You are not just investing. Also, when I talk about asset allocation, you want to think in the mindset of dynamic asset allocation. You should know at what time where to invest. It's not just like a model portfolio. You should put everything at the one time, 50% here, 25% here, 25% here. You should not have that mindset. That's not correct, I would say. And this is also where you want to go for a periodic review and rebalance of the portfolio, because as market move, your allocation will be drifting and bringing it back in line with what the main thing we need, kind of the consistent. So the main thing how the portfolio structured earlier, that need to be maintained during that time. So that for that the rebalance plays a big role. And when it comes to the stage three, which is where the most investors want to reach, that is 5 to 10 crore and beyond. Here, the focus shift again from just growth to risk management and the cash flow. At this level, protecting capital becomes just as important as growing it. You start thinking in terms of income generation, stability, and tax efficiency, right? You may kind of not want your entire portfolio exposed to kind of highly volatile kind of environment anymore. Instead, you want a mix that can generate returns while also giving you a liquidity and a peace of mind also. And across all these stages, one thing remains constant, as since we discussed from the start of this webinar: discipline. Not reacting to every market movement, not stopping your SIP during corrections, or not chasing short-term kind of noises. Yes, there will be opportunities. You should know how to capture the opportunity with a good additional capital what you can provide. Because the investors who reach 10 crores are not the one who took the most risk. They are the one who followed the clear process consistently. So this playbook is not complicated. It's about starting the disciplined growth, protect, and having a proper cash flow maintenance. And if you follow this process correctly, the journey from 1 to 10 CR becomes much more predictable and achievable. So now let me walk you through what we actually did in this market, because this is where the theory meets the real execution, I would say. So over the kind of past few months, especially in the post-March, we have been operating in what we call a macro reset environment. Earlier assumptions were that the stable oil prices, predictable inflation, steady growth have changed a lot with this geopolitical tension pushing this oil kind of towards much higher level. Global supply chain also getting highly disturbed, and the inflation interest rate expectation also shifting continuously, I would say. And the entire investment landscape has moved completely. And the reality is most investors are mentally not prepared for this kind of reset. So some are still expecting a V-shaped recovery that took place in the COVID, but while others have kind of become more extremely risk averse and moved away from the equity completely. But both extremes don't work. So our approach was very clear. We stay at a balanced, disciplined, and forward-looking. The first thing we did was continue the SIPs and increase the top-ups, because in the uncertain markets, stopping the investment is one of the biggest mistakes. But at the same time, we were very careful about where the money was going. We didn't just averagely blindly put into the fallen stocks or the sector. Instead, we directed fresh capital into the areas where we were actually seeing the value in the new macro environment. Because what worked earlier may not work going forward. For example, sectors dependent on a global supply chain or petrochemicals like are facing some pressure. So blindly buying in tips there doesn't make sense unless the fundamental supports it. That's very important. And the second thing we actually did was asset allocation shift. This is critical in this reset phase. Market are seeing high capital churn, investors moving money constantly because they are impatient with the short-term returns. But that actually destroys the value, I would say. So instead of reacting emotionally, we adjusted the portfolio structurally, balancing safety and opportunity at the same time, increasing the exposure where the valuation becomes more attractive. Like we also kind of ensure that the downside protection were also kind of the risk are also getting increasing because in this market, doing nothing is also more risky and doing everything impulsive also is more risky, I would say. And the third focus was a strong business, not just a popular claim, but fundamentally strong companies that can survive and grow through this new cycle because the market is shifting from chasing narratives to rewarding resilience. Interesting, you see, some of the better performance ideas in this phase have been contrarian. Companies that were not in the spotlight but were fundamentally aligned in the new macro reality. And most investors miss this because they are still focused on the past winners rather than this emerging opportunities. And finally, the one key thing is that we stayed close to our clients because this is a time the biggest challenge is not the market, it's a mindset. Investors tend to react to the headlines, geopolitical news, and the short-term movements rather than focusing on their portfolio strategy. So, a big part of what we did was continuous communication, helping investors to understand this is not a temporary phase, this is a transition phase, and portfolios need to be evolved accordingly. Because the simple truth is, portfolio built in 2025 will not automatically work in 2026. That's the truth, I would say. So, the change is very necessary, and those who are like fully adaptive and stay disciplined, invest smartly in this space are the one who ultimately benefits the most, I would say. Yes, the key takeaway will be the starting growth phase, then the protection phase, then the diversification phase, and main thing restructure as at this 2025 to 2026 phase, the restructure plays a big and kind of more prominent role. So yes, we come to the end. So the idea is very simple. Whether we are at the point where market are changing, strategies need to be evolved, and this is exactly where the right guidance can make a meaningful difference. Building a 10 crore CR, building a 10 crore portfolio is not finding one great investment. As I said earlier, it's about following the right structure, staying disciplined, and adapting to your wealth, adapting to your mindset where the wealth grows. And that's exactly what we need to do. And that's what we did. And I thought we work with the client across different stages of their journey, whether you are starting from your 10 to 20 lakhs, moving towards 1 crore through your M2W route, or already at a higher level where PMS strategies and a multi-asset portfolio becomes relevant. Through our MFD platform, we help build a disciplined goal-based portfolio using mutual fund with a clear allocation progression all through our PMS strategies. As with our different aligned funds and the synergy effects, we offer more customized, actively managed portfolios designed to navigate this complex market environment like the one we are right now today. Um, but see, across both, the philosophy remains the same, I would say. Clarity, structure, and discipline. There is no change in this. So, if there's a one takeaway I want to leave you is, it's don't approach investing randomly. Build a roadmap, and if you want help in understanding where you are currently stand, what gap exists in your portfolio, how you can really move towards your 10 growth, we are here to help you exactly to build a proper roadmap for it. Thank you everyone for attending this webinar. We can catch up in our next webinar. Thank you guys.